Good morning, ladies and gentlemen, and thank you so much for joining us as we present Let's Get Fiscal, how real estate and finance trends are reshaping Westchester's economy. I'm Dr. Marcia Gordon, President and CEO of the Business Council of Westchester. Today, we're taking a look at the overall economic climate, where commercial real estate financing is today and where the markets are headed. Our expert panel, and when I say expert, I mean expert, will examine interest rates and other influencers, break down the numbers, and explore the trends you need to know to get ahead in Westchester and beyond. We're happy to partner with Fordham University's School of Professional and Continuing Studies. Anthony, I think it's probably our 7th year or something. It's been a fabulous, fabulous partnership. Fordham School of Professional and Continuing Studies offers a number of bachelor's degrees, post-baccalaureate and master's degrees, including many areas of real estate, and a new master's degree in health informatics. And PCS just announced, listen to this, everybody, the launch of their Good Neighbor initiative, which offers an automatic 30% discount on tuition for Westchester residents in their undergraduate degree program at the Westchester campus. That's really, really exciting. Thank you to Dr. Anthony Davidson, Dean of Fordham's School of Professional and Continuing Studies, and the Fordham team. Dr. Davidson, I'm going to turn this over to you to say a few words.
Thank you very much, Marcia. Actually, the pleasure is completely ours. I'm very proud to have an affiliation with the Business Council of Westchester, which has done and does and will continue to do so much for Westchester County. And it's our recognition of the work that Marcia and her team does that prompts us to say we also need to do something for Westchester, and that prompts things like our Good Neighbor initiative. More importantly, we know that the talent and the expertise that the Business Council brings to the table, such as the people we have on the panel today. Although I was, maybe I read the title wrongly. I was expecting Olivia Newton-John to be a panelist, but apparently that didn't happen. So wow. It's our pleasure, Marcia, and the events, I think, keep on getting better and better and ahead and more ahead of the curve. So thank you to all our panelists, and thank you to the Business Council of Westchester and to everybody for making this event happen.
And thank you especially to you, Dr. Davidson, and Fordham University, whose presence in Westchester is really, really a shining crown in our educational landscape and community landscape. So thank you so very much. We also want to thank all of our sponsors, and especially our presenting sponsor, Wells Fargo, and introduce Melinda White, who is also a panelist, but is going to speak now as a sponsor. She is the Senior Vice President of Commercial Banking and leader for the Hudson Valley. Melinda?
Thank you, Marcia. And I want to thank the BCW team in Fordham for sponsoring this event, putting it all together. I hope it'll be a great event for everyone. Wells Fargo is proud to partner with the BCW to bring great content to its membership. And thank you for giving us the opportunity to do so.
Appreciate it, and we are very, very, very eager to hear from you and your great expertise. Thank you also to the Westchester County Office of Economic Development, who consistently works to improve the county's economic well-being and quality of life. This includes a broad range of activities to attract, create, and retain jobs, and to foster a resilient, pro-growth, and inclusive economy. Thank you especially to Bridget Gibbons, the director. We've also been so pleased to partner for years with the Hudson Gateway Association of Realtors, a not-for-profit trade association representing more than 14,000 real estate professionals in Manhattan, the Bronx, Westchester, Putnam, Rockland, and Orange counties. It's the second largest realtor association in New York and one of the largest in the United States. And again, fabulous, fabulous partners to us. Cutting and Feder proudly serves clients in real estate law, land use, zoning and development, litigation, trusts, estates, and elder law, public and private finance, including tax exempt and taxable bond financing, corporate law, telecommunications, energy and environment law, cannabis law, and nonprofit organizations. For over 50 years, they have established themselves as the leading law firms serving a vast region that includes Westchester, New York City, Connecticut, and the Hudson Valley. Their foundation is local, and they enjoy enduring relationships with leaders, institutions, and decision makers in the communities they serve. Thank you to the entire Cutting and Feder team, and especially to BCW board member Ian Nichols. RM Friedland is the largest commercial real estate services firm headquartered in Westchester County. The company has more than a 50-year track record of success advising building owners and occupiers. It is the only commercial real estate brokerage company in its markets that has experts across all asset types. Their award-winning team is well positioned to help execute any real estate strategy at the highest level. And thank you so much to new BCW board member, Sarah Jones-Maturo, for your leadership. Thank you all for your great support. It's my pleasure now to introduce Dr. Joshua Harris, who is a leading real estate economist and investment strategist specializing in real estate development, finance, capital markets, and business organizational leadership and strategy as the managing partner of the Lakemont Group, a boutique real estate and economic consultancy with offices in Orlando and New York. Dr. Harris has been routinely called on as an expert witness and for media interviews in the fields of real estate, finance, and economics. He is also an adjunct professor at the Fordham Real Estate Institute. Josh, let's get fiscal.
All right, Marcia, thank you so much. And we have a great panel today. I've been asked sort of before we jump to the panel to just do a very quick setting of the stage as sort of a real estate economist about, what might have been going on. And I was thinking about, well, today's June 1st. And I was thinking sort of in a historical context, looking back a year ago, where were we a year ago? What has changed? And obviously, how is that going to impact real estate markets, certainly across the nation, but certainly here in Westchester and even the broader real estate, in the broader business community. And a year ago, we were just starting to experience this thing that we've called a yield curve inversion, and we obviously have bankers here on the panel. We can get even more into this, where our short-term rates are higher than our long-term rates, which is generally considered a pretty bad thing. In fact, I'm looking at it right now, just, the US Treasury 1 month is at 5.2%, while the 10-year Treasury, which is often what sets the tone for mortgage rates and a lot of commercial real estate valuation, is at 3.6%. And that's, quite a big difference. And truthfully, we have seen interest rates go up in the last 12 months at, I think, one of the fastest clips that maybe the Fed has ever managed to do, obviously under the threat of inflation. So that's been the biggest change. And I think the thing that we are really still, I hate to say, just beginning to grapple with. All of this is also occurring under a landscape of recovery and resets to whatever we're calling a new normal in that post-COVID world, which I think is very unique for a place like Westchester, which is probably one of the most famous or storied, call it suburban commuter zones to obviously New York City, one of the largest, literally the largest city in the United States. So, what happens, especially if you'll talk about work from home, and obviously we can't help but notice that we're doing this via Zoom, which is something that is kind of a newer occurrence, that this is so new. And obviously, what is that going to mean? So we have a great panel to talk about those impacts and more. I'm going to just briefly introduce them, and then I'm going to throw out a question and we'll just go around. We have Nikki Greenberg, who has, I think, I saw real estate, I believe, futurist in the title, which is always an interesting title. So I think very exciting. And in her, I'm not going to read the full bios, but been very involved in real estate technology, spanning 2 decades. And I thought this was very impressive. Is recognized as one of the top five most influential women in real estate and a top 25 commercial real estate innovator. So she'll be very interesting because obviously God knows technology high dollar demands. We have Al Gutierrez, who's the managing director for JLL out of the Stanford location and works in tenant and landlord advisory, I believe primarily in the office markets, and has sort of been servicing the whole, certainly Westchester County region for quite some time, and is very knowledgeable about what's happening sort of on the actual real estate deal making space. As you've already met Melinda White, who is in the commercial banking leader for the Hudson Valley market. Clearly, the bank, what's happening in commercial banking is going to impact a lot about the level of financing, what is going on in certainly the ability for a business to, well, get loans and finance. And with her over 25 years of experience, we think we have a great panel. So I would like to start actually, we'll start with Al, we'll go to Melinda and then Nikki, in part because I feel like the futurists should be saved for last for impact. And this is, I'm gonna have an opening question that I think this is just a fun one for all of us who have any interest in Westchester County is, Manhattan obviously is our big thing down there, whatever we call it, where some of us commute to or used to commute to or would think about commuting to, is what is bad for Manhattan maybe actually good for Westchester, and truthfully, is Westchester maybe in an actual catbird seat to actually profit and really get ahead in all this great time of turmoil? So Al, you want to go first?
Thanks, Josh. Appreciate the opportunity to be here with everyone and talk a little bit about what's going on in the market. And of course, you're giving me a very challenging question because no one really has a crystal ball and understands what the future holds. Historically, Westchester was a recipient of many of the headquarters coming out of New York City, a relocation looking for a better way of work, a better way of life. And then we saw that there was a push-pull towards more of the urban setting, the work environment that was about densification, bringing people back to New York City, going back to where the talent is. And the question is, what does the future hold for us? We're starting to see some questioning as to what occupancy is going to look like. Do they need to be in New York City? Should we be thinking more of a hub and spoke mindset where we're bringing more regional offices to the market? And I think Westchester County, clearly from a locational standpoint, is well poised from that perspective. The proximity to New York City, the transit-oriented services that we have, the roadway infrastructure that we have are all very much positives. Where I think we're challenged and we have to do a lot of work, and I always look at this as opportunity. And so I'm interested to hear what Melinda and Nikki think about the future of real estate and the lending that revolves around this is, the trends are at a flight to quality. And so from that perspective, Westchester and the office market in Westchester in particular is dated. There's a lot of reinvestments that need to be done in this community in order to attract those occupants out of New York City. That 80-20 rule, which is 80% of the transactions are going to the top 20% of the market, where we're seeing trophy assets and single-digit vacancies, is consistent. And organizations can do that because they're identifying and they can afford to pay a lot more, where pricing and trophy assets have premium rents of anywhere from 40 to 50% over market average rents. Westchester is lacking in that product. And that's where I think we have a great opportunity of rebuilding this market and positioning ourselves to capture the velocity that could be coming out of New York City.
Let's go to Melinda. And I think Al kind of threw a question out about that ability to finance. I heard it there. So if you want to address my question and go with his, have at it.
Sure. So, Al, that's a great point that you bring up. Right now, the office market is in such disarray. In fact, what we're seeing is, major investors handing back keys, which is always disconcerting to us bankers and our credit folks. Office right now is a hard deal to get done and very building specific. So as a general rule, what we're seeing is that there's not a great appetite for refinancing amongst the entire industry of banks, of refinancing existing office. Where we're seeing some exceptions is where there's a very strong credit tenant in place, or, that there's, terrific occupancy. But as you said, Westchester's office space is dated. A lot of it goes back to the 1970s. There's been a lot of push within the Westchester community to convert that office space to different uses, just thinking about, Westchester Avenue, where IBM used to have, building after building, and, now we have a Wegmans. So there isn't that premium A-class space that would be necessarily attractive to a credit tenant, and it really is rather limiting, therefore, from a finance perspective.
All right, so I'd like Nikki, who has a very interesting background and point of view, I believe. So how, from your perspective, how does all of this, and please include some of the context around some of the major changes in technology and sort of future of real estate that you think apply most directly to Westchester, for the good or bad?
Yeah, thank you. And I think there's no way I could match what's, the insights and the expertise that Melinda and Al and yourself bring to the conversation, especially around financing and economic issues. My professional background is I'm an architect, so don't ask architects about financing. This is not our area. I kind of say I've come into this discussion as a bit of a wild card to bring a bit of a different perspective and maybe challenge some of the, maybe just challenge some of the views and bring a different lens to everything that we're seeing happening. When it comes to that relationship between Manhattan and Westchester, for me, I was in, I'm Australian. I know that Anthony was asking for Olivia Newton-John, but I'm next best thing, bringing Australia into the discussion. For me, during, I chose to be in Manhattan. I chose to be in New York. I left a beautiful country to come here. Went back to Australia during the pandemic and came back because New York is New York. And I believe that what's good for New York is good for Westchester. And really what we're seeing is that talent has options. They can be in New York, they can be in LA, they can be in Austin, or they can be anywhere. So if we want to keep New York being a thriving city and a thriving center of commerce, and we'll always have CBDs, we'll always need CBDs as a way to, bring creative collaborations and energy and everything else. If New York can be healthy, then, Westchester gets the benefits. To your point about, technology, and coming back to how you said exactly that around Zoom, the ability of us to be able to connect across geographies is absolutely fantastic. It also creates opportunities for people to not necessarily have to be directly in the city where the headquarters is. So, for Westchester, what I'd be looking at is saying, well, how do we ensure that the office market and the need for the office in Manhattan still exists? Because if people need to commute into the office, then they'll want to be in a commuter town. They're not going to be in Texas or in other places with better taxes. So I like to think of it as an ecosystem where everybody benefits. I don't think there's necessarily a competition between New York and Westchester. New York does well, Westchester benefits in many different ways.
That's excellent, and I want to provide a little bit of a little context, especially actually playing off a little bit what Nikki said about workers have choices. So in my background, one of the areas I sort of specialize in is in real estate market analysis. It's something actually, this is what I do for developers. Also, it's what I teach with Fordham in their program. And where people are going to go, where demand is going to grow to is always one of those interesting questions, and something that I've spent a lot of my career on. And we're in an interesting period where there's been this huge trend of urbanization, right? Going on really in the middle of the 2000s through, certainly if you look at what's happened in Brooklyn, is probably literally one of the globally led success stories. Westchester is one of those markets that, candidly, people have talked about not dying or using anything dire, but obviously that, the cool kids weren't maybe coming up wanting to, buy the house in the suburbs, but they instead were going to get this cool loft in places like, in Brooklyn, Williamsburg, and all those type of things. And what's interesting in just the last couple of years, and I don't think COVID was all about this, we've actually seen a little bit of a change up in the census data, because now we're starting to get really good data on this, and that's, and we're actually seeing that the suburban and even rural counties, and I mean, literally, this includes many of even the smaller towns. You go, the further up you go, the Hudson Valley, are starting to get some of the biggest percentile growth increases. Now, interestingly, New York is not going down. It's just that, it's older people that leave New York and they come up here often when they those millennials that, waited forever to have kids. Well, guess what? They're now old enough to be having kids. So suddenly, the desires do change. But it is something that I do think that this is an interesting trend change. And I had this last spring, for the first time, I had a student in my at Fordham, my development feasibility course, who did a Westchester project. Actually, it was an affordable project in Yonkers was where he centered his project upon. And I was actually thinking about, because normally I get students at like Brooklyn or Queens typically for their type of projects. And when I looked at the numbers, I'm like, this is the most obvious case ever. I mean, there's the population growth, the need was there. And I do think that the demographic shifts where people have choices, which I think is what Nikki was really saying. And I think everyone, and Al made the point, is that, the people have choices maybe to live. We can talk about residential, but do they actually have an office to work in? But I want to move to, the topic that I think we all know is very important for many of the businesses, not just real estate, transit-oriented development, and sort of what is going on in the transit space. So obviously, New Rochelle's had a lot of development. You're seeing more in Yonkers. You're seeing some of the cities, some of the towns. I believe Port Chester and others are have all approved more transit-oriented. Is this something? I guess my question really is, what's the future of transit-oriented development for Westchester? We know that eventually we might even have the New Haven line going into Penn Station as opposed to just Grand Central. And can we finance it? Is the real estate community up to task to providing that product? And I'm actually going to start with Melinda, and then we'll go to Nikki and then Al, just to shake up the order. So Melinda, if you would like to take that.
Sure. Multifamily housing is one of those sweet spots in real estate right now. The markets are very much open to multifamily development. Really, the limiting factor right now is the economics in terms of can, with these existing rate environment, can these projects pencil out? And we're seeing projects get put on hold because of higher interest rates. And in that case, it's not a lack of capital, but certainly just the cost of construction and the cost to carry that is the limiting factor.
Very good point. Nikki.
I might bring a bit of a different view, more around the importance of transit orientation, transit-oriented development, and the expectations of future generations. Future generations that are coming through. I know, Joshua, that you referenced millennials, wanting to have kids and then moving out to places like Westchester. But we also need to look at the next generation coming through, which is Generation Z. They're already 24, 25 years old, and they're starting to enter the housing market. And they're a generation that has different expectations. They're more than other generations. They're actually very involved in wanting to be homeowners. So they're definitely not a generation that should be overlooked. And they're well ahead of millennials. For them, one thing we know is that they love technology. We know that. We know that they also care very deeply about the environment. And we're seeing car ownership in this generation go down. Few of them are getting driver's licenses. So it's a natural fit for them to want to live close to where they work, or at least live close to, good quality, highly connected transport. So I think we definitely can't overlook them and their expectations. So I'm a big fan, and the more we can do it well, the better.
Al, go ahead and give your view on trends, and also if you want to include any thoughts you have on co-working, and if that's something that we might see more of that, because I think that might fit in. I know you're an office expert, so might be a good tie-in with the transit question.
So, I think one feeds the other. And Westchester has been quite successful over the last decade to really acknowledge the fact that from a transit-oriented perspective, we needed to densify. We needed to bring more housing to the market. As Melinda has already indicated, multifamily was a hot product in the market during this period of time and continues to be, albeit we do have the difficulties from a financing standpoint. And for us on the office side, it's the housing then attracts the employers, because a lot of these employers that we work with are always talking about the cost of housing in Westchester County and the lack of housing in Westchester County. You see these residential buildings, these multifamily buildings, towers going up in New Rochelle and White Plains and Yonkers, and the occupancy rates are just phenomenal, and in part they're coming from New York City, they're coming from the surrounding boroughs. I like to define Westchester County as the 6th borough of New York City, because surely that's going to be the trend. And as there are more of the millennials coming to the market and more of the Z generation coming to this market, quality of life is very important to them. And so our hope and what we think will be a positive for Westchester County is that quality of life will demand, these employees will demand of their employers that there's easier access to their workspace. And so therefore we'll bring up that employer base as well. Human capital is the biggest value that any organization has, and creating an environment that caters to that human capital is exponentially valuable to the major corporations and the employers in this market. So I think that's something that from a local government perspective, we need to really focus more on how do we work in tandem with these developers to bring that density in. Albeit, I understand there's a need to still, retain some of the essence of the suburban market.
All right, very good. And so I want to shift slightly, Al just said said a few things that I want to carry in on. I'm going to ask Melinda, a question about with office, tenants. Let's just be clear. One of the challenges in the real estate market, and I think in the office markets in particular, is access to capital and what valuations are, right? And I think so. If a new business or a landlord needs to get a line of credit or a direct loan in order to expand, to reconfigure their space, build out their space, or otherwise open up, to fund for everything from furniture, fixtures, equipment through the hard capital expenditures that a building requires. Melinda, what does the lending market look like right now for that type of if Al wants to do a big deal, but he needs a bank like Wells or somebody like that to come in and finance it? What's that experience like? And is it going to get better, worse? Like, what are you seeing out there on the day-to-day?
I would say with office space, again, it's a tough market. Everything is on a case-by-case basis, as I'm sure you're well aware. But if there's a good story to tell, then there's an appetite. But I would say that for office space right now, mostly what we're seeing is also investors being very cautious about putting more money into buildings as well. A lot of them have refinanced and have taken money off the table. And now when their maturities are coming up, what we're seeing is cash in refinancings, where, because of the rise in interest rates, debt service can't be covered with at the higher loan amounts, and owners are having to reach into their pocket, which then just becomes a downward cycle, right? Because if they don't have the liquidity to put money into the building, then, you know, there's an inability to attract good tenants. So it really becomes a very vicious cycle, and one that, you know, we're watching very carefully, frankly.
Yeah, and I suspect that that's how you're going to answer, because I think that's the reality. And you know, this is an interesting question. I'm gonna direct it to Nikki, just because I think she has probably a unique view, might have a unique view on this. But one of the biggest debates that I sort of have seen really bubble up just in the last couple months, even though if it was there since the start of COVID, is this whole work from home hybrid. You know, is it functional? Both from the, I mean, there's the real estate side argument, and there's also just the corporate side, or the workplace productivity argument. And you know, I have to say, we're doing this on Zoom, and I always make this, you know, an observation about how when you're debating the work from home environment, when you're doing it literally in the, you know, or debating the in-person versus the in-person while we're doing this, there's something just ironic about it. But, you know, I never taught a full online course until I was literally forced to in the middle of COVID, because, you know, it couldn't go into person. And, you know, it has its challenges, it has advantages. I find that, you know, doing work and having meetings, but I have to say that even as a real estate person who I'm supposed to maybe be diehard, no, we all have to be back in the office. I have to just candidly admit, I can get a lot done remotely, and including be it from teaching, meetings, selling conservative. I mean, there's really nothing I haven't executed. And is this something that more companies? So Nikki, to you, are we on a technology trend where almost remote, or sort of remote capable first, be it in synchronous or asynchronous format, whatever the work cadence is? Is that the new normal, or are we going to get kind of sick and tired of this, and then we're only going to do these events if we can all be sitting back at, you know, at some conference room at the Marriott like we used to do all these things, right? Where do you see this going?
Yeah, that's a great question, and a good tie into some of the other things. I think one of the big overarching things you need to remember is that we can't group every single person and every single organization into one bucket. And I think that's what's causing a lot of, you know, more than a lot of confusion, but a lot of contradictory anecdotes or contradictory evidence about where people are productive, you know, what works well, what are people asking for? No, we're living in a time where, you know, we get to bring ourselves to work. We get to be individuals. We get to choose where we want to work, and now we're getting to choose how we want to work. You know, in days gone by, we had to go into the office because that's where your files were, that's where your computer was, that's where your phone was. There was no other option. That's the way that work got done, right? You know, 30 years ago, that's the way it got done. You know. Now we have an option. So it's kind of this option that's opened up, and it's got to come down to what's best for each company's, you know, each manager and each company, each department, according to their team, their preferred way of working, what actually works well. I know it's kind of confusing, and it seems like, oh, there's like 50 different options and who's coming in and blah, 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 blah. But I think we need to reframe things a little bit and say, well, actually, it's freeing because we now have a range of options for how and where work can get done. And then we get to choose and design the way that it's done. And I mean, I talk about this a lot, and I'll give you kind of the summarized version is that when we're talking about the future of office and the future of work, we actually need to understand that it's not just where are we working, but organizations actually need to redesign the way that they think about work, you know, and how product, you know, and how outcomes are measured, et cetera, et cetera, et cetera. So I'm with you on that. There's a lot of benefits to being able to do a lot of things virtually. I think for a lot of us, when we go to conferences, we're so damn excited to see everyone. It's just like, you know, you're hanging out, you're doing things all the time. A lot of us, you know, I think it's fair to say, and I don't have the numbers around it, but I think a lot of us have stopped attending virtual conferences, you know, day-long events, because we find them tiresome. So there's a time and a place for everything. So as I said, like, I'll just kind of sum it up in one thing, is that we get to choose and we get to design what is optimal, what that mix is, and redesign the way that work is done in an organization and then how it's done. So we've got to actually think of it as empowering. And I kind of layer on that any real estate group that is actually looking at office space, they should also be advising on, well, let's actually look at how you run your company. What is the best way for you guys to work? And then we can provide a solution around, space, technology, and, culture, digital transformation, a whole kit of parts to create a productive and happy work environment.
Yeah, Nikki, that's a great point. Actually, I'm recently had an article published around sort of using hospitality underwriting metrics for underwriting office buildings, and sort of, what this a little bit, if you're not in the weeds of the office market, I'm not going to go deep, but we typically valued office buildings because they have these really great long-term stable leases. We treated them like bonds, and it was great from an investor. What a great cash flowing, I can get this asset. And obviously the banking sector, I don't even need to ask Melinda, we know that makes it really easy to finance. But with all this, we're now getting in this place where companies probably don't know what's going on. And I'm going to ask this question to Al, because he's the one of all of us that probably spends the most time talking literally to tenants and landlords and in the deal space. How are companies and even landlords, but specifically the users, those tenants, those businesses themselves, how are they looking at that question? And are they leasing, hopefully that I want to get my people in, so if I don't have the space, they won't come in? And look, I have to candidly say, and I'll agree or disagree with me, but if you're going to have a 3-day-a-week model, I don't exactly see how you reduce your space, because it's just that it's going to be hypothetically dark Monday or Friday or whatever the cadence is. But what are you seeing when you're actually talking to tenants? How are they doing this? Is it changing their locational strategy? And if so, how?
So first, I want to get back to your question on co-working, because we are seeing, and sorry I didn't answer that earlier, we are seeing an uptick, and this is more anecdotally, but we are seeing, I was walking through an office building in downtown White Plains the other day, and they have a co-working facility which is actually serving as an amenity to the tenants in the building, because it serves as swing space, it serves as incubator space for the landlords, and their occupancies have upticked to over 80% right now. To go back to your question of what we're doing on a daily basis and how we're talking to both occupiers and owners in the market, we're constantly reevaluating what the strategy is going to be. It does start with workplace strategy. What does the workplace of the future look like? Are we accommodating seats for all of our employees? Are we creating a hoteling environment? Are we creating what is defined now more so as a convene environment, where it's a place where people just come for think tank and meetings? So the problem is that this analysis is really delaying decision making, because no one really knows what the future of the workplace is going to look like. However, we're starting to see problems arising from this inability to make decisions on a return to office perspective. Just recently, the Bureau of Labor Statistics reported that we have had the greatest decrease in productivity at 1.9% in over 75 years, over a 2-year period. So from Q1 of 2021 to Q1 of 2023, we've seen a 1.9% decrease. That is greater than the 1973 to 75 drop in productivity. What we're seeing moreover is that young talent that is working in a remote environment is developing at a slower rate. We're seeing that there's a massive impact on innovation. Of course, I'm jaded, and many people will say, well, Al, you do office leasing, so you're gonna want to talk about these things. But the realities are, there is an intangible value in that coffee clutch, right? In that pantry discussion, in being able to walk into someone's office with an idea and think tank. It's difficult when you're in the Zoom environment and you're trying to locate people in order to have those last minute conversations. And then, from an employee engagement standpoint, that's dramatically falling as well. So there's this push-pull that leadership is having as to quality of life, what's important for my employees and what's important for the organization, that is starting to reverse. AT&T, as an example, has just announced that managers and various other roles must return to work on a regular basis. BlackRock is now saying they're going from 3 to 4 days a week later this week. Now, the truth is, we've been talking about 3-day work weeks, 4-day work weeks ever since, I was in college. And what that's going to look like going forward is a big question mark. But to answer the workplace piece from a landlord perspective, we have the push-pull with lending and Melinda's side. We need to reinvest. We need to create an environment that is going to attract these occupiers out of New York City to the buildings. So what comes first, the chicken or the egg? Do we invest and put all of the amenities and all the services in? And how do we finance that? Because without that, we're not going to be able to attract these occupiers. Look at Stamford, Connecticut. In the midst of the pandemic, 677 Washington Boulevard, a 700,000 square foot former UBS building, leased up. It is now 100% leased over a 3-year period. That's an anomaly in the suburban markets. And now 400 Atlantic has huge activity. 200 Elm, all of these buildings that have created these immense amenities packages and really created a phenomenal workplace environment are the ones that are leasing. And they had to spend the money before the tenants came. So you have to build it for them to come.
If you build it, they will come. That is a real estate mantra that is actually served pretty well in historical framework. And I couldn't help but think about something. As I look at the clock, I know we don't have a ton of time left, but it is, I think, one of the things that certainly as the economist perhaps in the room, it's been on my mind for literally, I think, since April of last year, with the first time I kind of wrote or presented any, call it the recession risk or recessionary environment discussions. Obviously, when the Ukraine, when Russia invaded Ukraine, which seems like so long ago now, and we had all these supply and other disruptions, all these things. I was like, well, this could, on top of, we were still having continuing problems with China and supply chains. I was like, this could be it, right? This is finally where we're gonna, our rope is gonna kind of come to an end, and then we've treaded along. And I looked at the most recent Atlanta Fed, GDP now, they call it the nowcast for Q2, which we only got literally a month left of still a 1.9 growth, which is not that fast, but candidly, it's how we spent a lot of the last decade. So that's the predicate. The question, and we'll go Melinda, Nikki, then Al on this, is that there is the Federal Reserve has racked up rates incredibly. There is various stress in lending, in consumer markets increasingly, but certainly business to business. I saw some stats from Moody's chief economist just recently, about business to business sales slow down and all these various problems, even though we have a great employment market that's persisted for maybe a host of reasons. What happens when a recession comes? And obviously probably brings rates down, but what's going to happen to Westchester in particular, and sort of, from your perspective? And, is Westchester sitting in great risk, or maybe in that perverse way, it benefits some of these suburban markets because cost cutting, which is a little bit, and when we swing to Al, I want you to think about how cost cutting is maybe, because historically recessions cause people to not lease office space or reduce their office footprint, irrespective of any of this work from home discussions. So I'd like to know what you think will happen if we have a recession, realizing that the interest rate risk, and that, I hate to say, that's almost been maybe what the Fed has been trying to do without saying it. So Melinda, then we'll go Nikki, then Al.
Hi, Josh. So, it's interesting, we're talking about rates a lot and how much they have increased. And certainly I think it's fairly unprecedented that the Fed has raised rates so quickly over such a short period of time. But for those of us who have longer memories, 5.5% or 5.25% where we are now, SOFR, is it's sort of the normalized rate pre-Great Recession, or the Great Recession of 2007 through 2009. So it's interesting that we've gotten so used to free money for so long and how that has impacted asset values and how that could negatively now impact asset values. We're seeing a 50% decrease in acquisition requests, financing for acquisitions. So there's a lot of price discovery going on between buyers and sellers. Right now, what we're seeing in the market is, negative leverage. It's, it's more costly to buy than the cash flow that's coming in, right? Cap rates are still fairly low. Interest rates are higher than cap rates. It doesn't make for a good, vibrant buy-sell economy. So really where this lands up for Westchester or, the nation more broadly is how long do rates stay high? Does the Fed-induced or Fed likely to induce recession bring rates back down? And so, sellers were right to hold on to their properties a little longer, or, do rates stay elevated, longer than everybody was expecting, and then sellers have to adjust their expectations. I think that's the big risk to the economy here in Westchester is what happens to asset values overall, more broadly. What we're seeing just recently in the last couple of weeks in the rate curve is that, there's not that same anticipation that rates are going to drop fast. And I think that the rate curve is telling us that maybe this rate environment is going to last a little bit longer. The long and the short have gotten a little closer together. So with that, we'll have to wait and see what happens. If inflation does start to come down, there will be a case for rates to come down. But I think Jerome Powell and the rest of the Fed governors have been very, very explicit and sort of having a scratch your head moment. Why is nobody believing us when we keep saying that, we're going to do whatever we need to do to tampen down inflation. And so I think that will, as that rolls out over the next 6 months, as we see the data actually come in, will really tell the tale of which way we're headed.
I think that's a great. I have to agree with you, Melinda, on with the situation with rates. Is they're truly not, from any historical standpoint, that high, and I think actually they're probably more operatable. In fact, that's probably why the risk is maybe overstated on some levels. But at the same token, I don't think they come down necessarily very fast. And if they do come down very fast, or just come down substantially, it's because something very bad happened, right?
Mm-hmm.
I mean, they went to zero because we had a pandemic. They went to zero before because we had the global financial crisis. So, I mean, there's a little bit of be careful what you wish for in this type of a world. And I think that's a good point. So, Nikki, what do you think? Does a recession? And I'm gonna throw the question. I'm gonna throw a comment to you, Nikki, and I want Al to also listen and pay attention to it. But I have heard people more on the landlord side, I'll just say, with this like catbird grin that like, oh, well, if there's a recession, it's going to be good for us because employees are going to be afraid to come about their jobs. So they're going to more opt to come into the office because, and I've jokingly said there'll be some tech person who will like host a surprise 3 p.m. all hands Zoom call and say, well, those of you who are in the office, congratulations, you still have your job. Those of you who are at home, I'm sorry, thank you for your service, something like this. So do you think a recession change? I mean, and I have to this first comment and say, I always thought what a horrible managerial concept of scaring people in that way. But, that aside, Nikki, do you think, does a recessionary and maybe does it change this whole technology, some of these things in discussion? Is it meaningful?
Sorry, I was laughing at that. Imagine, your analogy. Imagine if you're not in the office, we're cutting access and goodbye. I think that's what everyone expected, that the fear of losing your job would be enough to actually want to be in the office, to be seen and have that face time. But there's still this resistance, and there's enough articles that have kind of said that, well, people are willing to take a pay cut or move jobs or do other things just to retain that flexibility because it means so much to them. So, not quite there. But I might just kind of piggyback a little bit off what Melinda was saying. And, one of the things is with this climate at the moment is that if there is a recession, it's not like it's going to be unexpected. So we're not going to be caught unawares. We can see that something is coming. and it's part of the real estate life cycle. So for the industry, there will be those that are ready to pull out that playbook. You know, there's a lot of players that are waiting for distress that, you know, they're sitting there and waiting. It's, you know, it's an atypical climate, but there's a normal way of doing things. So I like to always bring a technology spin to things, and this is maybe me getting on my soapbox, but I'll use this question as the opportunity for it. So when there's a slowdown, when you know, when there's less work coming in, this is the time that we really should be investing in research and development. And this is the optimal time to go through any kind of digital transformation efforts. So if the work is slow, you've got some people in your team that have excess capacity that they can actually use for other things. So if you're thinking about maybe whatever it might be, maybe bringing in a new CRM or doing some kind of data strategy or doing something else, this is the time to do it. You don't want to be doing it when things are, you know, super busy and everything's flying around. This is time to actually go, okay, well, maybe I'll treat my business as the customer to go through this process so that when we get to the other side of this tumult, we're actually, you know, well positioned for, you know, for being a future ready organization. So that's me in my soapbox, but I'll hand it over to Al.
All right, Al, go ahead with impacts of recession potentially here to Westchester otherwise. And you're still muted, Al.
There we go. And I couldn't agree more with what Nikki was saying about, you know, recessionary periods being periods of opportunity to rethink, reassess, reinvest. You know, there's a lot of capital out there that has yet to be deployed. So, you know, from Westchester's standpoint, I think you're going to see a lot of opportunistic investors looking at these assets that are you know, on the brink of foreclosure or you know, on a fire sale, for lack of a better term. Many will look at it as land banking opportunities for future residential redevelopments. Many will look at it as acquiring office assets at a low basis point where reinvestment and repositioning is affordable. One of the things that has ameliorated downturns in the market in Westchester are alternative industries. We're seeing healthcare, life sciences, and education at the forefront of occupying much of the obsolete space that's in the market. So I think that there are certainly opportunities and ways to capitalize on a recessionary period. Now, yes, Josh, you're absolutely right. We are all saying that recession will force people back to work because unemployment rates unemployment goes up. Employees are fearful of losing their jobs, and they'll all feel the need to return to the office. What is going to be interesting is all of these organizations that have already taken these cost-cutting measures by shedding space, subleasing space, or writing it off during the pandemic. What are they going to do when all of these employees do come back? So I've been doing commercial real estate in Westchester County and office leasing for almost 30 years. And if I don't look at the glass as being half full, there's a problem in what I'm doing. So I do think, and my mentor said it to me many years ago, if I didn't say this already, he said, during a down market, that's the best time to create opportunity. So
it's a good point. I do have to say, if we're thinking the recession could fear people back to an office, I should always point out is maybe the persnickety real estate economist. Well, historically, recessions always had companies shedding off. So maybe because wait a minute, that work from home thing, you're paying for your office. I don't have to pay for your office anymore. So that is the flip side. We'll see what happens. We do have some questions in the Q&A. We're going to try to get addressed. I think they're good questions here. So this first one is directed to Melinda, although Al might be able to add some context to it. It says, this is from Jeremiah. Melinda mentioned keys going back to lenders in the office building market. In a company with over 10 million square feet of office space in the county, we don't see it with us or our competitor peers. I know it's happened in markets like Portland, San Francisco, et cetera. Has it really happened in the county? So just real quick, have you seen, have there been any office defaults or voluntary turnbacks to lenders?
Not that I've seen in Westchester.
Okay.
The questioner was right in saying, you know, we saw it in San Francisco with, I think it was Blackstone, you know, handing back the keys, but that does ripple effects, you know, bankers read newspapers.
There's definitely been some in Manhattan, that's some very famous
in
ones,
Manhattan.
and some under the radar ones too that don't get pressed because they happen in ways that don't always generate traction. Al, have you seen, I'm asking, are you aware of any in your space? Has there been any, default?
No, we haven't seen any defaults. You know, there's certainly several assets that are on a watch list at this point in time. But interestingly enough, what we've seen is those buildings that were in fear of default were acquired by users at the end of the day, and it was a saving. It was an opportunity.
Got it. So maybe the market actually cleared fast enough in so many ways.
Yep.
There's also a follow-on with this one that to Melinda about just, do you think that, with interest rate reset, right? Obviously for refinances, what happens to all, because of all the various loan underwriting metrics that maybe the loan were, I think you may have said it earlier about, I think if I heard the phrase cash in refinance, I remember learning about the Texas closing back when Texas buildings were, the oil declines in the 80s. Is that what you're seeing? Is the cash in refinance, which guess is that the answer to this person's question? Like, as interest rates reset, you're going to see more of that?
Yeah, I think you're going to definitely see more of that.
Which is obviously distress if they don't have the cash.
Correct.
Right.
And that's that vicious cycle that, that's why leverage works well when, everything is on the way up. On the way down, it is really a game changer.
Got it. I think we have one last kind of a question here from the audience, from Stuart, and this will probably, from looking at the clock, will probably be the last question, just time wise. We've talked about office and residential. What are your thoughts on commercial warehouse space in Westchester? Evaluations up or down, or occupancy rates up or down? And just a general thanks for the information. Al, you're making a motion. What do you want to answer?
Hottest product in the market, period. Up, up, up. When I started working in this market, rental rates on a triple net basis for industrial, warehousing, distribution, logistics were low single digits. We are now over $20 triple net, performing better than any office product than most office product, not than any, in the market. And occupancy rates are in the the vacancy rates are in the low single digits. It is really hot, and we don't have enough of it in this market.
Yep. Melinda, is it easy to finance that product on a relative basis?
Industrial properties are still very much sought after properties for banks and other finance companies.
Okay.
It is a very hot market, yes.
Yeah, I will tell you that that's a nationwide trend too. So I think we're really coming to time. So at this point, I'm going to ask Marcia to come up and wrap us up. And to all my panelists, thank you. Amazing job. Thank you, thank you, thank you.
You are all amazing and so enlightening. And this information is so important as we all unbelievably begin to plan. It's June 1st today, so it's coming up to the half-year mark, and we begin to plan for 2024 and beyond, right? And what happens in the commercial real estate market in Westchester and the Hudson Valley, even in New York City and the broader region, really affects all of the business community in Westchester County. So the valuable insights you all brought today are so important. I've been watching the comments in the chat, and people have been texting me, and we are really proud of having you, of having the honor to host you. Josh Harris, you're a fabulous facilitator. You have so much information. Thank you for your expertise. And to our panel, Nikki Greenberg, Alta Gutierrez, Melinda White, also our presenting sponsor, Wells Fargo. Thank you so much. Our partner, Anthony Davidson from the Fordham Real Estate Institute. Thank you for your work. And all of our other sponsors, Westchester County, Department of Economic Development. I don't want to miss anybody here. The Hudson Gateway Association of Realtors, Cuddy and Feder, RM Friedland, thank you so much for everything you bring to our community and especially the real estate landscape to create a very, very positive, diverse economic environment in Westchester County. So with that, have a good day, happy June, and thank you all.
Thank you so much.
Thanks, Marcia.
Thank you, Marcia.
Much.
Thank you, Josh.
Thank you all.